So this is the, if you get on Yahoo Finance, you will end up on this screen. And because it is a free site, you will unfortunately will get a lot of advertisement, as you can see. So some of the key takeaways, so this is when I'm recording, today it is Sunday, September 5th, 2021, and the data obviously will be end of last week, which is Friday, 4 o'clock Eastern Standard Time, when the stock market closes. So on the top over here, it gives you, some of the major indices. As far as what happened, it was, S&P 500, which is a stock index that includes 500 large companies in there. So it's pretty diversified. Dow 30 is 30 stocks, and so that's diversified, not as diversified as S&P 500. Then you got NASDAQ that includes many of the technology stocks, a lot of the drug companies. Russell 2000 is, it includes 2,000 companies, but these are the smaller companies and so on. So those are the four major indices that you will hear if you're watching business-related shows, or if you're reading a business-related articles in the newspaper or Barron's or Wall Street Journal, etc. They're going to refer to that. If I click on the right a little bit more, you can also find what is happening to the price of the crude, so that you can click on that, and if you can get more information on it. Over here is the gold, silver, and then also one of the major currencies, and there are many. One of them is euro versus US dollar. So it'll give you that. So if I wanted to click on any one of these things, for example, if I want to click on crude oil, I will get down into more information about crude oil. And, during the day, this chart will have more data than you will see it, on the weekend. But so let me look at like S&P 500. So S&P 500, which is the index for average of 500 stock. Here you can see it has provided me with the chart during what happened on Friday. The market opens at 9:30 Eastern Standard Time, and then it closes at 4 o'clock. So you can see during the day what happened. It provides the data for S&P 500, and similarly I can get for any of the indices if I want. I can also look at it in terms of term. This is one day. If I wanted to see 5 days, 1 month, 6 months, year to date, which means from January 1 till now. 1 year is 12 months, so would be 12 months from now, so that would be including part of the prior year, 5 years, and the maximum. So if I look at, say, 5 years, if I click on it, you can see the chart over here. The S&P 500 index. There was a drop in because of the COVID. There was a big drop, and then it kind of has gone up and down, and that's what it is. So one way to look at the index would be to look at a fund, be a mutual fund or ETF, and you will learn about it later in the semester. Would be anything that represents S&P 500. So for example, if you take a fund which is symbol is SPY, if I hit SPY, and you'll see S&P 5 ETF, so it's a fund, so if I click on it, and it basically is a proxy of what S&P 500 does. So right now, when you cannot buy S&P 500 index, because it's just an index. What you can buy a fund that replicates S&P 500, and there are funds in Vanguard, there are funds in other like Fidelity funds, etc. that would quote unquote mimic S&P 500. So this is one of the quote unquote funds that mimics a S&P 500. And so what do I mean by that, right? So if I look at so again, this gives me the chart, but if I look at the performance, let me go click on the chart first. If I click on the chart here, it'll get me to the interactive chart. If I wanted to compare it with the index, for example, here, in here, save it over here. So you can see that the fund, the blue line, let me just take that out so you can see it. This is what the SPY, the S&P 500, one of the ETFs or funds are there. So you can see, over the last 5 years, because I clicked on 5 years over here, over the last 5 years, it is going up and down. This was a drop here in and because of the COVID last year in March, and then obviously went up, and it has gone up since then. But if I wanted to see how does it compare with S&P 500, if I click on it, if I save it, you'll see, it's right on top of it, which means you cannot see the two lines, the blue line and the light blue line basically on top of it. And the reason is because this fund basically is replicating S&P 500 index. So you don't buy an index. You typically would buy a fund like an SPY or the other funds like that. Now, while I'm on this chart, what does it show me? If I click on at any point, and again, obviously, if I move the mouse, you may not be able to see it. So up here, as I move, you'll see these numbers are going to change depending upon where my line is. So as you can see, just watch here on this box over there. As I am moving, you can see that the numbers are changing. So any point, if I want to know exactly that particular day, what the quote unquote the market value was, I can do that, and basically tells me. So any point I can do, you can see that. Now, the other thing it will also show if I'm doing it for a longer period, and because I'm comparing two charts, it will give you in percent. So this basically means that over the 5 years, S&P 500 has gone up 100%, 106% to be exact. Down here, basically these lines over here, the bar graphs basically is the quantity, the volume of how many millions of shares of S&P, as SPY, the symbol SPY was purchased, or there was a volume of buying and selling going on. So that's what basically means. You can see when there was a big drop, there was a lot of selling. The red line basically means that particular day that the stock market that day was down. The day you see a red line, that particular day it was down. The green line basically mean it was up. That's really the purpose of red and green lines over there. And you can look at it obviously, in the long term for maximum and so on. Now here is so I'm going to take the S&P 500 out, and you can see over here now. If I go in and compare it with one stock, let's say if I want to compare it with, so I can go in and click here, and I can type in a symbol. So let's say I want to compare it with General Electric. The symbol is GE. If I click on it, it'll come up. I'll save it, and I want to save it here. You can see that if somebody would have invested in GE 5 years ago as a single stock, they would have lost 56%. This is the light blue line on the bottom. Whereas if they would have invested in a broad-based fund that has got 500 companies, they would have been 106%. Now, obviously, there are some companies that have done better than S&P 500, right? So let's look at some of the other companies that we kind of hear about it every so often. So I am going to take I'll leave the GE in there for right now. Let's say if I put in Tesla, the electric car company that we hear a lot about. If I click on that, and it basically is done so much better, basically stayed very much low, and then all of a sudden it took off. And so now you can see that it did 1,700%, but you can see that it's a lot of volatility in the stock is going up and down a lot. So let's say if I look at more a short term. So let's say if I'm looking at it more what is going on in 6 months. So if I look at this 6 months, the blue line on the top is the S&P 500. So if you think about it, obviously, if over the last 6 months, somebody would have invested in S&P 500, they would have done as well, as slightly better than Tesla, obviously way better than the GE. But let's say if I put in another stock in here, let's say we put in, maybe I'll put in IBM. Okay, so IBM, if I put IBM in there, it's gonna give me a different color. So you can see overall, IBM over the last 6 months has done relatively well, almost as good as Tesla, but not as good as this GE has done over here. But now if I go long term, if I go 5 years, you'll see Tesla has done the best because because of the success in their company, the stock price has really gone up. Now if I take Tesla out, now you can see clearly what happened to IBM and what happened to GE. If somebody would invested in IBM, they would have been down 12%. In the last 5 years, GE would have been 55%. Again, S&P 500 would have been, over 100%. If I throw in, let's say, another company like Amazon, So Amazon has done quite well over the last 5 years, but again, suppose I'm looking at a more short term, 1 year. So you can see that Amazon has, over the 1 year period, the overall stock market has done, has done better in some ways. For example, over here, this stock is the General Electric, because over the last few months it has done quite well. So the whole idea I'm showing you this stuff is to kind of play with the stocks that you like. You can also put in any index in here and stuff like that. So let me make one more point before I kind of wrap it up for this particular thing. Again, the whole idea is for you to get comfortable with this tool. It is free. It is out there. I want you to kind of think about it, look at it. But let's look at something else. Let me take out General Electric. Let me take out IBM. Let me take out Amazon and just leave the S&P 500. Now I'm going to compare it with something that is more like it's a bond, which means that it's not stock related, it's more bond related. So one of the fund is LQD, and you learn about the bonds later on in the semester. So I'm going to over here. So you can see overall the bonds have not done as well because of the interest rates being so low. So basically over the 5 years, somebody would have kept the money in the bond. The bond value would have basically stayed flat at 0.03%. Now along the way they would have made some money, which this does not represent. When the bond gives out interest, you collect that separately, so that's not priced in the value of the bond. But overall you can see that the stock market has gone up so much, but the bond market is not, because of the low interest rate. Now here is one thing I do want to show you. If I look at a period where there was let me go to 2 years. So you can see that when there was a COVID, both bonds and stock dropped. And this is where you kind of see that there is quote unquote overall concern, regardless of their bonds or their stock. And they both dropped because of the uncertainty of COVID. But overall, with time, bond and stock both recovered. Bond has basically stayed relatively flat, whereas the stocks have gone up. So one of the things, obviously people wonder is how come stock market has gone up so much? There are many reasons. Overall economy is doing well, but other reason is because the bonds basically are not making enough return that people prefer taking the risk. And this is where the risk conversation comes in, where people are more interested in taking the risk, and they're taking the risk with the investing in the stock market. And that's the reason why, obviously, when there's a demand for something, in this case, people want to invest in the stock market because they think they can get a better return, which has driven the stock market up. So the question, obviously, always on the horizon is that if the interest rate starts to go up, what was going to happen in the stock market? We don't know, obviously. It's all speculation, in one's mind. But at some point, there will be some concern if the economy is getting too heated, if the inflation starts to go up. If the inflation goes up, the Federal Reserve will start to change their monetary policy. Right now, the monetary policy is to keep the interest rates very, very low. And interest rates low, if you have money in the bank, CDs, savings, or even the bonds, you're not making any money. So people are taking the risk of the stock market. If the interest rate starts to go up and the bonds are giving you a slightly higher return than they are right now, some people may take some money out of the stock market and put it into the bonds or CDs. And at that point, stock market may come down because people are selling, to some level. How much will it come down? Who knows? But that's the kind of thing to think about when you're looking at it from a market risk versus the stock specific risk, of bond risk versus the stock risk, and so on. So hopefully this is helpful as you're looking at this particular week and as you're looking forward into this week, which is the stocks, and the next week, which is the bond.